Price revisits these gaps, there's typically a higher likelihood of rejection as the market reacts to these areas. But what happens if the price fails to reject these zones and breaks through instead? This creates what's called an inversed fair value gap. An inversed fair value gap occurs when the market neglects the original FVG, breaking through it instead of respecting it. This shift transforms the FVG into a new type of zone, changing its role from a supply or demand zone into its inverse counterpart, depending on the direction of the breakout. For example, if a bullish FVG is broken to the downside, it becomes a supply zone, signaling potential selling pressure. Conversely, if a bearish FVG is broken to the upside, it shifts into a demand zone, indicating possible buying interest. Now here comes an important point. When a standard FVG and an inversed FVG overlap in the same area, this creates a high confluence trading zone. These areas are powerful because they combine the remaining institutional activity from the original FVG with the new characteristics introduced by the breakout. Traders can use this overlap as a prime opportunity for entries, provided they align with the broader market context and structure. So let's see a real chart example. Here on the Euro-Dollar 15-minute chart, we start with a clear uptrend. The market makes an aggressive push to the upside, forming a fair value gap and breaking above the previous market structure. This breakout is a strong signal that buyers are in control, and the price is likely to keep going higher. But then, things take a sudden turn. The price drops sharply, breaking below the previous low with strong momentum and creating another FVG zone. Now here's the interesting part. Look closely at how the initial FVG overlaps with another in the same area. This overlap creates a high-quality supply zone, a key area where sellers are likely to step in. When the price retraces back to this trading zone, there's a higher probability of rejection, pushing the price downward. This setup offers a prime opportunity to enter a short trade, aligning with the bearish momentum. Sometimes, overlapping two zones creates a large trading area on the chart. The issue with a large key zone is that if you enter at the start of the zone and place your stop loss below it, or even lower, like below a swing low, you'll end up with a wide stop. This can result in a poor risk-to-reward ratio, sometimes even less than 1-to-1 before the price reaches important levels. So how do you fix this? The answer lies in optimizing your entry to secure a better price and tighter stop loss. One simple approach is to aim for the middle of the zone. While this reduces your risk, the downside is that you might miss some trades if the price reverses before reaching that midpoint. Another technique is to use a Fibonacci retracement tool. Apply it to the impulsive movement, starting from its beginning to the end, and look for correction levels such as 61.8% or others that suit your trading style. Combining Fibonacci levels with overlapping zones can help you pinpoint more precise entry areas. Alternatively, you can wait for confirmation before entering. For example, a long wick rejection at the zone indicates that the market is reacting strongly to that level. You can then enter at the close of the rejection candle and place your stop loss below the zone, giving you a more calculated entry with reduced risk. While these techniques can improve your entries, the key is to backtest and refine them based on the asset you're trading. Price action works across all markets, but each trading pair has its behavior and characteristics. What works on one pair might not work as well on another. Consistent backtesting will help you understand which methods perform best for your strategy. That wraps it up for this video.